Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with CEO and founding partner Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our investment-grade credit mandates. Generally, March was another challenging month for fixed income. However, volatility subsided mid-month, and our funds were able to produce their 12th consecutive month of positive performance. Andrew, can you highlight the main contributors to performance throughout the month?
Thanks, Hunter. Yeah, March was definitely a challenging month. We did see credit spreads widen globally as a result of the rate volatility. We saw positive contributions from some of our credit hedging strategies that we have placed in the portfolio. Opportunistically, there was profits in U.S. telecom and technology. Verizon and Oracle both issued jumbo U.S. dollar deals that performed particularly well. We participated in those and they helped the portfolio. By contrast, there were challenges in Canadian telecoms. The Rogers-Shore merger announcement was not well received by bond investors because it's perceived as increasing leverage. We did actually have some core shorts in that sector in Canada, which helped us with performance. Overall, we're pretty satisfied. It was a challenging month, but we finished with positive performance. And given how difficult it was for most core fixed income strategies, we're pretty happy coming out in the green.
Thanks, Andrew. As we head into what tends to be, on average, a positive month for many asset classes, how are we setting up the portfolio?
Yeah, I talked about in our last commentary that we had reduced portfolio exposure by about 30%. And in March, we were cautiously adding back. We added about 25% of to our overall risk profile. Most of that we were adding in Canada and Europe, which we think offers more value as the reopening story remains behind where it is in the U.S. U.S. spreads are closer to the tights. There's a lot of optimism right now, but we think that Canada and Europe will sort out their vaccination issues and play catch up in the second quarter. In terms of sectors, we were mainly adding to bank and energy exposure and U.S. telecoms, as I talked about earlier. Meanwhile, we were reducing to Canadian real estate simply because of how overheated the Canadian housing market is. It feels like a good time to take profits in that sector.
And so, what is your outlook and some opportunities you're seeing for Q2?
Yeah, as I talked about, we're most bullish on Canada and Europe simply because they lag the reopening story a bit and they have room to catch up to the US. I would say overall, looking at the first quarter, the Fed will be very happy with how it played out. We saw 10-year US yields almost double from 90 beeps to 1.75. Really without much impact on risk assets. And I think that will just give the Fed confidence that it can allow rates to rise even further. We'll probably see a period of consolidation in here in that 150 to 175 area, but I would not be surprised to see US 10-year yields hit 2% before they see 1%. So investors need to remain cautious here on core fixed income. Away from that, falling volatility, a slowdown in new issue markets into the summer could see credit spreads push back to the tights or even through the tights by the end of the second quarter. So we remain pretty optimistic, but we're vigilant that we can protect investor capital.
Thanks again, Andrew. If you have any questions, please feel free to reach out to a member of our team. Thank you, and stay safe.